Welcome to Markets Now. I'm Michelle Rook with Jim McCormick, agmarket.net. A mixed day in both grain and livestock futures trade. First off, over in the grains, row crops to the plus side with wheat lower. And were we putting weather premium back into the corn and soybean markets here, Jim, or was this all technical?
It's a combination of both, Michelle. The first thing is the weather. Coming out of this weekend, the maps have really gone hot and dry, especially for the Western Corn Belt. The 6 to 10 day, as well as 8 to 14 day, are calling for below normal precip and much above to very much above normal temperatures. We're seeing triple degree temps being forecasted. So that's definitely not what the market wants to see, or excuse me, that's definitely what the crops want to see for this time of year, especially in the beans going to August when they are made or broke per se. Corn, it's a little bit mixed bag. Some areas definitely don't want to see it, but some areas actually are saying this is not all that bad because the crop is behind, and getting a few weeks of heat they think will help kind of push this crop along, which was kind of off to a slow start due to a relatively cool spring.
So what kind of a yield do you think we're currently trading? Are we still at 181 and 52 or not?
I think that's where we're at. I think you've got some yield models that would suggest that we could actually get 182, 183 on the corn and maybe push these beans a little bit higher. But I would argue, Michelle, that is probable. But the fact is, it's probably going to be easier to see some of the yield come off over the next couple of weeks than continue to improve, because a lot of these yield models are based on crop ratings. And I would anticipate the crop ratings to seasonally decline as well as just decline based on the forecast, especially in the West.
They're going to have to decline quite a bit, though, for the funds to get really excited, aren't they?
I think it's going to be kind of an interesting bag, Michelle, because in the fact of the matter is funds are carrying a record short position in the beans. The corn, they were carrying a record short position just 2 weeks ago. They lightened up by roughly 10,000 contracts. So I think if you start taking out some technical resistance, you take out on the beans roughly this 1086 level, the downtrend line, you could see up to a 50-cent rally. That's about a 50% retracement from the July 4th weekend high, or excuse me, Memorial Day weekend high to the July low. It's also the 50-day moving average. If the corn takes out 26 and a half, it could rally 20 cents up to its downtrend line. Now, I think the funds will lighten up that position, but I do not anticipate them to go completely flat. I think they lighten up, and then in general, will re-engage, add, and start putting those cells back on, looking for that fall break.
Well, we just got above the 20-day moving averages in corn and soybeans in the new crop category, and that was a pretty tough lift, wasn't it?
It was. It took a knife fight to get through it. The other thing, the markets, like I said, the funds covering is the bullish side of the equation, Michelle. The bearish side of the equation is the reality is there's still a lot of grain in the producer's hands, especially the old crop corn, as well as a lot of new crop bushels. I think we've seen a lot of estimates that say less than 10% of this new crop corn has been sold. So if we do get a rally, part of the reason it's going to maybe stop the rally from going as high as we all want is the farmer. When he gets engaged and he starts selling that position aggressively, that potentially could cap the rally.
Okay, so we've covered that it's partially weather premium, it's partially the funds covering shorts, but is it also a little bit about demand, especially since we've seen some flash sales for soybean exports, and soybean meal sales and exports have been very good?
We're finally getting competitive competitive on the pricing of it. We've getting some flash sales. We've heard some rumors the other day of potentially China buying more beans. China has been way behind their purchases. They've purchased about 10% of where they normally should be. This is the time of year they should purchase. Now it's going to be interesting to see what happens politically. Up to a week ago, looked like the odds were high that President Trump was going to get reelected for a second term. And a lot of people were fearful maybe a trade war going on. And the thought is maybe China would come in and get a little bit more aggressive, trying to front run a potential Trump presidency. But once President Biden withdrew from the race, it looks like it's going to be more of a toss-up. So it'll be interesting to see how far China gets engaged. But this is the time of year that they should be buying. And so I would anticipate more buying, hopefully.
Now, you mentioned that farmer selling could also cap the rallies here. And how much inventory is still out in the country, old crop for corn and soybeans, do you think?
Well, the corn's probably the biggest problem. Remember, on June 1, the government said we had about 3 billion bushels of corn sitting in the farmers' hands. And, if you just do the math, I think you probably got maybe 500 million to 750 million sold right now. So you probably got at least 2.5 billion bushels in the farmers' hands. And the real problem is, Michelle, is we only need maybe half of that, or about 500 million of it, because the anticipated carryout is 1.9 billion. So we're getting to the point where if you are holding grain right now, that window that somebody's going to need it is going to close very, very quick. And then you're going to see the basis fall apart. We are already starting to see that in the August beans. If you notice, folks, a lot of the grain bids for old crop beans have all shifted away from the August contract. They pushed them out to November contract. We've seen the basis drop as much as 30, 40 cents in certain locations because plain and simple, we're getting to the point in the old crop beans where the market no longer needs them. And they're now saying we've got enough to get us to new crop and we're only going to bid for new crop now. So old crop pricing is imperative right now if you have some.
Yeah, something to keep an eye on for sure. Okay, the wheat market went the opposite direction of the row crops, but we've got the wheat quality tour going up in North Dakota. They're finding record yields there. And then we still have a big winter wheat crop we're trying to work through, right?
Exactly. That's what's putting the pressure on it. I mean, I'm hoping this wheat's trying to bottom out. We're through the harvest, obviously, in the hard red and soft red wheat. Technically, we're holding those lows, but yes, that big spring wheat crop from that survey, or that tour, I should say, definitely kind of put a damper on it. The market is in a search of demand. We've seen some demand for wheat. That's going to be the key. The other thing to keep an eye on, Michelle, is the U.S. dollar. If the Fed starts cutting rates, as a lot of people are anticipating, some people are saying maybe even a surprise bigger cut than a quarter, than what a lot of people are thinking. If we got a surprise aggressive rate cut, that would probably be bearish to the dollar, because the higher dollar has been driving, or higher rates have been driving money into the U.S. dollar. So if you see the dollar break, that would do wonders for demand.
Yeah. So let's talk about the cattle market. We started off mixed to lower, but had a nice surge about noon as we had some cash trade. I think 190 in the South was a couple bucks better. Was it all about cash though?
It was definitely part of the cash, but the other story is the economic models. The GDP came out reading today and it smashed it. It was a lot better than people were anticipating. And it shows the economy continues to grow. And a lot of it was driven by the consumer. And, a lot of people are questioning, would the consumer be there because of credit card debt and some of the other economic signals we've seen? But at this point, Michelle, the consumer showed us at this point, they are willing to spend money. So you've got the recipe for higher prices. You've got a consumer that is willing to spend, and you've got a market that's got tight supply. That's the perfect reason for the price to go higher.
Futures at a discount to the cash. So do we still rectify that through the bull spreads, or what gives here?
Right now, it's, we'll see if the consumer continues to do it. I think if the Packers can get that cash market, they can keep pushing the beef out to the consumer, the prices go up and hopefully they'll meet at a higher price level.
You bet. Do you think we'll go and take out the July 5th high in the August? It's been kind of leading things here.
Right now, the charts suggest they're going to. We've had another strong close, so I would expect that to happen, actually.
Gotcha. What about the hog market? We've had a nice run. Was that just some profit taking today, you think? Did we run up into chart resistance or what?
We went right up to some chart resistance. I think we went right up to the lows that were scored about October of a year ago. We've also hit some other horizontal resistance. So I think, we were a little bit overbought. We have put in what looks like a V bottom. So a little bit of correction isn't out of the equation, but it does look good for the hogs right now.
Yeah, and cash and cutouts have certainly improved here counter seasonally, haven't they?
They have. I mean, it shows the demand's there. And it's not just there for the U.S. I was reading an article, Michelle, that Argentina, which traditionally is a big beef eating country, has downshifted down to pork because of their economic situation. So they are eating more pork. So, you are seeing the demand for that product, not just here, but around the world. And that's always a good sign.
Thanks so much for joining us, Jim McCormick with agmarket.net. That is Markets Now.